Is crypto starting to fall behind the system that it's attempting to replace? The US government is about to define the rules for stablecoins, the digital currency that connect today's usable dollars to those who use crypto, decentralized finance, and other global payments. The latest version of the so-called Genius Act, which made claims to bring clarity, reveals a blueprint for federal control over arguably the most essential and important infrastructure and functionality in crypto. Here's a first look at what's going on, what this bill says, enables, and why everyone with a bank account should pay attention. No hype, red or blue, no partisan spin. We'll see what's it about at the surface level, its mechanisms of control, what's purposely omitted, and why it matters. Welcome to the Wealth Explorer. Let's answer the most important question. What exactly is a stablecoin? Think of it like digital cash. As it is of general knowledge, most of the world's economy relies on US dollar transactions. They have to be quick to make, as seamless as possible, and cheap. And while Bitcoin goes up and down and behaves more like a fund than a currency for everyday's transactions, stablecoins are more suitable for the task. They're designed to hold a steady value of 1-to-1, usually matching a fiat currency for ease of conversion. So why the insistence to have them instead of the already developed system we have? See, for instance, when money is sent overseas, stablecoins can be faster and cheaper than using banks' networks. Also, in countries with crashing currencies, people can use them as a safe haven. Here's the catch though. Until now, virtually nobody was checking if these digital dollars are actually backed by what's known as real money. That's where this new Genius Act comes in. So, let's dig in. The surface level. On mid-June this year, the Genius Act made a leap in its legislative process. And luckily, it's not the same Big Brother's look-alike that was thought to be a couple of years ago. So far, it does three straightforward things. Licensing. Only federally approved banks, non-banks, or state-approved entities can issue stablecoins. This may be the end for a Terra-style self-balancing algorithm-based coin. Transparency. Issuers must hold one-to-one reserves in cash or short-term treasuries with monthly audits. Which makes me wonder, do banks have the obligation to back in a one-to-one ratio the amount of money reserves or equivalent that they approve in loans? Let me know if you're curious about how banks can give more money than what they have stored. Anyway. Redemption guarantees. Since issuers should have a solid backing of their stablecoins, users should easily be able to cash out their crypto for dollars. This puts anyone who wants to play this game in a tough spot, since we know now that having cash sitting around or under the mattress as reserve is not the best of ideas. If you want to know more about why holding on to your banknotes might be worse than using them, check this video. Mechanisms of control. So, the bill creates something unprecedented. A federally supervised parallel banking system for stablecoins, with the comptroller of the currency and Federal Reserve as its gatekeepers. So these are the mechanisms. The 10 billion trigger. State-regulated issuers can operate freely, whatever that means, until they hit $10 billion in market cap. Then, they'd be forced under federal oversight, which feels unlike local empowerment. It's more of a bait and switch for consolidation. For reference, how much money is 10 billion US dollars these days? Visa has around 12 billion in transactions per day in the US and 9 billion more in Europe. Per day. This means that any successful issuer of stablecoins will, more quickly than not, end up under the crosshairs of federal regulators. Transaction freezes. Regulators can halt stablecoin activities if they deem an issuer unsafe. Imagine having no need of a court order to halt trades and withdrawals. Custodian control. The Genius Act mandates that only government-approved custodians can hold stablecoin reserves. On paper, this protects users from another FTX-style collapse. No more platforms gambling with customers' funds, shady financing of politicians, or redirecting money from one country to another, or laundering of donations and NGO funds. But it also effectively and implicitly bans decentralized finance from handling stablecoins, since, for instance, algorithms can't be approved under these conditions. This creates a paradox. After 2008, we learned banks could gamble with deposits, yet were deemed too big to fail. Now, the same institutions can get control over stablecoins, while decentralized alternatives, which survived every crypto crash without bailouts, are regulated out of existence. The question isn't whether we need safeguards, which why not? It's why the only acceptable custodians are the very entities that required $700 billion in taxpayer bailouts in 2008, charge large fees for basic services, and have the privilege to inflate the currency. Decentralized finance had its Wild West phase. Maybe it's done, but the solution shouldn't necessarily be a return to centralized gatekeepers. There could be a middle ground. This law isn't really seeking it. Interoperability. The bill requires stablecoins to work seamlessly with other payment systems, sort of like how the EU forced Apple to use USB-C. No more walled gardens or proprietary plugs. When it comes to money, the Fed's getting to set the standards, meaning that future CBDCs will likely be the reference design. Compliance may require know your customer / anti-money laundering hooks disguised as security features. But decentralized protocols that can't embed these features become incompatible by design. More than which charging cables to use, this draws a parallel on who controls the supply of cables. And history shows us, universal standards tend to centralize control. Take a look at SWIFT, the system that allows many countries to do business with each other. This system's also used to sanction and isolate entities and individuals, such as independent journalists, public figures, and even whole nations, keeping bidirectional financial trade cut off. This is one way in which modern siege warfare works. The very feature meant to simplify payments could quietly exclude alternatives that don't play by Washington's rules. Global reach. Such need for interoperability pressures foreign stablecoins to comply with US rules or be ignored or blocked out. And although this is up to bilateral agreements, we know who's the heavyweight here. It's like that saying, you can have a car in any color as long as it's black. Wait, what was the moral point of blockchain technology again? Anyway, what's not covered and why it matters. The Genius Act excludes algorithmic stablecoins like the Terra project, crypto-collateralized stablecoins like DAI, all other altcoins, tokens, memecoins, and cryptocurrencies. By narrowly defining payment stablecoins, the bill safeguards the hegemony of the current system without really breaking apart anything new, and it leaves everything else vulnerable to other agencies' crackdowns. Control the on-ramps first. The unanswered questions. This has left actors such as Bitcoin and Ethereum in peace, since they operate within different areas of the crypto space. But there are 3 existential questions for crypto. Will decentralized stablecoins survive? The custody rules could make DeFi utopic developments illegal. Is this a CBDC Trojan horse, or this is the bare minimum to keep both systems, current fiat and new crypto, in peaceful coexistence? And who will be holding the leads? Banks and compliant issuers gain. Privacy and innovation might lose. So, that's what we have so far. The Genius Act is undeniably a clearer step in power shift. In the never-ending race for a one-world government, for the first time, it seems clearer that the United States could have direct authority over the stablecoins that underpin crypto markets. This really makes me wonder, what's the point of making new innovative systems if they're being held by the same old-fashioned mentality of control? What do you think? Is this a step towards the stability crypto needs, or the first step towards centralized control? And if you want a deeper dive on whether decentralized stablecoins and finance could be a better alternative to what we have in place now, let me know. This is the Wealth Explorer. See you in the next journey.